Welcome to the deep dive. So, if the market feels like it's sending, well, mixed signals lately, you are definitely not alone. Today, we're plunging into the dynamic world of Bitcoin and the broader crypto ecosystem. We've got some recent intelligence to really help make sense of it all, our mission, basically, to unpack Bitcoin's choppy price action, those subtle shifts in institutional money, the, quiet but pretty profound evolution of corporate adoption, and that whole global regulatory dance. All these pieces are creating a unique moment of tension and maybe opportunity. Okay, let's unpack this. What's really happening beneath the surface, and what does it all mean for the future of digital assets?
Yeah, what's truly fascinating here is how the market seems pulled in, well, maybe three distinct directions. You've got the long-term Bitcoin HODLers accumulating.
Right.
Then you have institutions making this, frankly, surprising pivot towards Ethereum. And then layered on top, global regulators are now actively competing, not just watching. It's not just a simple crossroads. It feels more like a multi-directional tug of war. It's really a snapshot of an asset class maturing, but with these powerful, sometimes opposing forces at play.
Okay, let's start with the most immediate thing, this thing you might be feeling day-to-day Bitcoin's price. Over the last, say, 24 hours, it's been stuck in a pretty tight sideways corridor.
Yeah, really range-bound.
Oscillating between roughly $111,000 and $113,500. Now, this stabilization comes after that notable 10% retreat from its recent record high. That was over $124,000 back on August 14th, wasn't it?
That's right. Push it down to its lowest level in nearly 7 weeks.
So in this consolidation phase, this sort of sideways grind, what are the critical price levels we should really be watching?
Okay, so technical analysts, they're pointing to some really crucial levels here. On the downside, the big one is $109,000. That's seen as a pretty significant support zone. If we get a definitive break below that, well, it could trigger a broader short-term correction across the altcoins too, not just Bitcoin.
Okay.
Further down, you've got defense lines around $107,000, and then that big psychological number, $100,000.
Always seems large, doesn't it?
It does. And conversely, looking up, the formidable resistance zones are near $117,000, and of course, that recent peak around $123,000.
And what's the general feeling, the sentiment?
Well, expert commentary is pretty split, actually. Some analysts see this as a healthy pullback, maybe a chance for accumulation. Others just see it as a holding pattern, waiting for a catalyst.
Makes sense.
Short-term momentum is definitely fragile. If you look at the relative strength index, the RSI, it's showing negative momentum. But interestingly, an RSI below 30 can also signal that things are oversold. So a bit of a big signal there, too.
And how does the bigger picture, the macro environment, play into this? We hear things from the Fed.
Right, that's a great point. We've heard, generally dovish signals from Federal Reserve Chair Jerome Powell recently, and typically that kind of talk benefits risk assets like crypto.
Yeah.
But then you've got these political pressures happening at the same time, and that seems to be driving some capital towards traditional safe havens like gold. Gold has really surged lately. So again, conflicting forces.
Okay, so this brings us to something really interesting. These conflicting signals from different parts of the market itself, like on-chain data versus maybe what the big players are doing.
Exactly. On-chain data, which, looks at actual transactions on the blockchain, it seems to point towards long-term conviction. We saw a net outflow of 192 BTC from centralized exchanges recently, first time in 10 days.
And that usually means?
That usually means investors are moving assets into private wallets, likely for holding. It signals accumulation, long-term belief. But then you look at some of the market's largest holders, the so-called whales, and they seem to be showing signs of profit-taking. Address is holding between 1,000 and 10,000 Bitcoin, and even those over 10,000 Bitcoin, they've actually declined to a one-year low.
So accumulation by some, profit-taking by others. How do we square that circle? And what about the derivatives market? What's that telling us right now?
Yeah, it's a fascinating picture. These signals really create what we can call an investor-trader standoff.
Okay.
If you look at the options positioning data, it reveals that $116,000 has emerged as the max pain level for the upcoming expiry.
Max pain. Remind us what that means again.
Right. So the max pain theory basically suggests that the price tends to gravitate towards the level where the largest number of options contracts expire, worthless. It maximizes the financial pain, if you will, for options buyers.
Got it. So 116K is the pain point.
Yeah, and a max pain level above the current spot price, like 116K is now, implies that derivatives traders, sort of in aggregate, are positioned for a short-term move higher. They're betting on a spike.
So let me see if I've got this right. Long-term HODLers are buying
Accumulating, yeah.
conviction. Whales, the big holders, are selling off a bit, de-risking.
It seems like it.
And the short-term derivative traders are betting on a price jump soon.
You've got it. Those opposing pressures are essentially neutralizing each other right now. And that's creating the choppy sideways action we're seeing.
So the eventual breakout, up or down, depends on who blinks first, or who commits more capital.
Precisely. Which force proves stronger in the near term?
Okay, fascinating standoff. Now, let's pivot slightly because there's another critical narrative emerging, a shift in institutional capital. While Bitcoin's kind of stuck, Ethereum seems to be stealing the spotlight.
Absolutely stealing the spotlight. The data from the U.S. spot ETFs is really stark.
Tell us about it.
Well, Ethereum ETFs attracted a record-breaking amount, roughly $455 million in net inflows over just the last 2 days. BlackRock's iShares Ethereum Trust, that's ETHA, brought in about $323 million of that. And Fidelity's Ethereum Fund, F, added another $85 million.
Wow, $455 million in 2 days for ETH ETFs. How does that compare to Bitcoin's ETFs?
Well, in stark contrast, Bitcoin spot ETFs saw a modest net inflow of approximately $92 million over that same period. Now, that did break a 6-day outflow streak for Bitcoin ETFs, which is positive.
Okay, some relief.
But it's just dwarfed by Ethereum's numbers. If you look over a 5-day period, Ether ETF saw about $1.83 billion in inflows. That's roughly 10 times Bitcoin's $171 million inflow over the same 5 days.
10 times. So what is driving this sudden, really aggressive institutional conviction towards Ethereum? Is there a clear reason?
Well, the timing suggests it's not coincidental at all. This surge is happening right after that landmark legislation, the Guiding and Establishing National Innovation for U.S. Stablecoins Act, the Genius Act, was signed into law back in July.
The stablecoin regulation, how does that connect directly to Ethereum inflows?
It connects very directly because
Yeah.
the vast majority of stablecoin value and, crucially, stablecoin transaction volume resides on the Ethereum blockchain. Think USDT, USDC.
Right, most of the big ones run on Ethereum.
Exactly. So by providing the first clear federal regulatory framework for this massive, multi-hundred billion dollar stablecoin market, the Genius Act effectively de-risked a core component, a key utility of the Ethereum ecosystem.
So institutions which crave regulatory certainty.
Precisely. They likely see this as a green light. It's not just about investing in ETH, the asset, anymore. They're likely seeing Ethereum itself as a, well, newly regulated financial platform. That clarity makes a huge difference for institutional comfort levels.
That makes a lot of sense. Okay, so beyond these rapid institutional moves, there's also a quieter but maybe equally significant trend happening. Corporations adopting Bitcoin for their treasuries. And it seems like it's evolving beyond just buying and holding.
Yeah, it's definitely getting more sophisticated than just simple accumulation.
We're seeing examples like Amazing AI PLC, that's a UK-listed company. They actually raised £72,000 specifically for their Bitcoin treasury policy. And they did this even while acknowledging the high-risk warnings from the UK's regulator, the FCA.
That shows real conviction, doesn't it? Despite the regulatory cautions.
It does. And it seems to be part of a bigger trend. What are the numbers looking like?
Well, current estimates suggest there are at least 126 publicly traded companies now holding nearly 820,000 BTC on their balance sheets.
820,000 BTC. And what made this even more attractive recently for CFOs? Wasn't there an accounting change?
Yes, exactly. That was a huge practical catalyst. The new accounting rule from the Financial Accounting Standards Board, FASB, now allows for fair value accounting of crypto assets.
Meaning
Companies can now mark up their Bitcoin holdings to market value on their financial statements if the price goes up. Before, they could only mark it down as an impairment if the price fell, but couldn't mark it back up if it recovered unless they sold it.
so that removed a major disincentive. You don't get stuck with an artificially low value on your books.
Precisely. It makes holding Bitcoin much more palatable from an accounting perspective.
Okay, but here's where it gets, I think, really interesting, moving beyond just holding. You mentioned sophistication. Tell us about companies like C2 Blockchain Inc. and DOG Coin.
Right. This points to a potentially new, more advanced phase of corporate strategy. C2 Blockchain recently expanded its holdings of a coin called DOG, reading over 331 million tokens. Now, what's critical here is that DOG isn't just another random crypto asset.
Okay.
It's actually a meme coin, yes, but it's issued natively on the Bitcoin blockchain itself using the relatively new Runes protocol.
Runes. That's the new standard for creating tokens directly on Bitcoin, right? Like fungible tokens.
Exactly. And C2 blockchain's rationale, according to them, isn't just pure speculation on a meme coin.
So what's the strategic angle then?
Their management views these runes-based tokens, like DOG, as creating tangible on-chain utility. They argue it drives transaction activity on Bitcoin, which, crucially, generates fee revenue for miners, and it helps attract new users to the Bitcoin network.
Ah, the transaction fees. That becomes more important as the block subsidy drops with each halving, doesn't it, for network security?
Precisely. As that block subsidy decreases over time, transaction fees become absolutely critical for funding Bitcoin's long-term security budget, paying the miners to secure the network. So by investing in an asset like DOG that, in their view, promotes on-chain activity, C2 blockchain is effectively making a strategic investment in the sustainability of Bitcoin's security model itself.
Wow. Okay, so that marks a really significant potential shift from just viewing Bitcoin as passive digital gold to actively participating in and maybe even investing in the digital economy being built on Bitcoin.
Exactly. It's a much more active, ecosystem-focused approach.
That is a fascinating evolution from digital gold to, yeah, an active digital economy. But I have to ask, isn't there still a pretty significant speculative element when we're talking about something literally called a meme coin like a DOG, even if it is on the Runes protocol? How do you separate the strategic utility argument from just, hype?
Look, that's a really fair question, and it definitely speaks to the ongoing maturation, or maybe the growing pains of the space. Speculative elements are almost certainly present, maybe even dominant initially.
Right.
But the strategic rationale that C2 blockchain is articulating, it goes beyond just hoping the price goes up.
Yeah.
Their focus seems to be on the network effect these tokens could potentially create.
More users, more transactions.
Exactly. More users, more transactions mean more fees for miners, which, as we said, ultimately underpins Bitcoin's long-term security. So it's presented as a calculated bet on the potential utility these new Bitcoin native assets might bring to the network itself, even if their initial popularity is perhaps driven by meme culture or community excitement.
So it highlights businesses getting more sophisticated, looking beyond just the price ticker.
I think so. They're starting to understand, or at least bet on, the broader ecosystem dynamics.
Indeed. Okay, let's zoom out again to the global picture. The world's major financial jurisdictions, they're clearly no longer just debating digital assets. They're actively implementing concrete legal frameworks now.
The era of ambiguity is definitely fading.
Yeah, it's being replaced by what some people are calling regulatory competition. It almost sounds like countries are competing for, I don't know, the crypto Olympics, trying to set the rules in a way that attracts innovation but also protects consumers.
That's a good way to put it. There's definitely a race element now.
So what's the latest in the U.S.? Where do things stand?
Well, the U.S. is definitely moving towards building out a framework piece by piece. The Commodity Futures Trading Commission, the CFTC, they're significantly overhauling their market surveillance capabilities, bringing in NASDAQ technology. They're explicitly preparing for an expanding regulatory remit in crypto.
Even though the big bill defining their jurisdiction, the Clarity Act, is still stuck.
Exactly, even with clarity stalled in the Senate. Meanwhile, you have the Securities and Exchange Commission, the SEC, whose crypto task force, operating under Commissioner Hester Pierce, is holding these nationwide roundtables. They're actively gathering input from early-stage projects.
That sounds different from the usual SEC approach. More consultative.
It signals a potential shift, yes. Maybe moving away from a purely enforcement-first strategy towards something more consultative, at least in some areas. And of course, the Genius Act for stablecoins is now law. But industry groups are still lobbying hard, especially for explicit legal protections for non-custodial software developers within that stalled Clarity Act. They want to ensure developers aren't held liable just for writing code.
Okay, so progress, but still some key pieces in motion in the U.S. What about the EU? They have their comprehensive MiCA regulation already in place, right?
They do. MiCA, the Markets in Crypto Assets Regulation, officially entered into force in June 2023, and now we're really starting to see its impact ripple through the member states as they implement it locally.
Like where?
Well, Greece, for example, has just introduced a much tougher licensing regime for crypto exchanges and wallet providers. It's explicitly designed to align with MiCA's pretty stringent standards on things like governance, capital requirements, consumer protection.
So raising the bar for operators.
Definitely. Greece is also preparing to introduce capital gains taxes on crypto profits looking like 15% for individuals initially, and they're considering a 24% VAT on certain crypto-related services.
Taxes coming too. But does MiCA's clarity also help innovation?
It seems so. The flip side of stricter rules is predictability. For instance, a company called Young Platform just announced plans for Europe's first MiCA-compliant crypto-native neobank. So yes, higher regulatory hurdles, but that clarity is creating a pathway for new regulated business models to emerge.
Interesting trade-off. Okay, and then how is the UK operating outside the EU's MiCA framework, charting its own course? Are they diverging?
They are diverging in some key areas, yeah. The UK seems focused on integrating digital assets into its existing financial framework, rather than creating a completely bespoke crypto regime like MiCA.
How so?
Well, a big step is implementation of the OECD's global standard, the Crypto Asset Reporting Framework, or CIRF. Starting January 1st, 2026, the UK will require crypto firms, exchanges, brokers, wallet providers to collect and automatically report detailed customer transaction data to HMRC, the tax authority.
Ah, the taxman cometh.
Indeed. And there are potentially hefty fines for non-compliance, up to £300 per user if a firm fails to report correctly.
Okay. And where are they diverging from the EU? You mentioned stablecoins.
Yes, interestingly, the UK Treasury has confirmed that, unlike under MiCA, they will not require foreign stablecoin issuers, like, say, Tether or Circle, to establish a physical entity in the UK or be subject to caps on transaction volumes as long as they meet certain standards.
So that's a clear strategic decision to attract international stablecoin business. Make the UK a hub.
It certainly looks that way. A deliberate divergence from the EU approach, likely aiming to be more appealing to global issuers. But consumer protection remains a huge focus for the UK's FCA. They're constantly issuing warnings against unauthorized firms, and they reported a staggering 4,465 instances of crypto-related impersonation scams just in the first half of 2025 alone.
Wow. So it really underscores how these major financial powers are now actively competing, balancing innovation, taxation, and consumer protection, each trying to find their own optimal mix.
Exactly. It's a dynamic global race.
Okay, amidst all this market churn, the institutional shifts, the regulatory maneuvering, it's almost easy to forget about the absolute foundation of Bitcoin itself. What's happening down at the core protocol layer? Is it stable?
You know, it's funny you say easy to forget because the base protocol layer remains this absolute bastion of stability. And that's kind of the point.
Boring is good in this context.
Boring is a feature, not a bug. The operational status of the Bitcoin network is just normal, no major incidents. Version 29.0 was deployed smoothly back in April 2025. There are no ongoing critical security advisories for the core protocol.
So all the hacks and threats we hear about.
They're happening at the application layer. Phishing scams, malicious browser extensions pretending to be wallets, social engineering attacks trying to trick people into giving up their keys. That's where the risk is, not at the core protocol level. That fundamental layer has proven incredibly reliable, immutable, and secure over time. That stability is, frankly, a profoundly bullish characteristic. It provides that solid, predictable foundation everything else builds on.
That's a crucial point. But stable doesn't mean stagnant, right? Is development still happening to future-proof it?
Oh, absolutely. Stable doesn't mean development has stopped.
Yeah.
The community is actively future-proofing Bitcoin through the Bitcoin Improvement Proposal process, the BIP process.
I mean, what, for instance?
Well, one really significant area is addressing the long-term theoretical risk from quantum computers. There's ongoing work defining a multi-phase migration plan to move Bitcoin towards post-quantum cryptographic standards.
How would that even work? Upgrading everyone.
The proposed plan is quite clever. It would eventually, likely decades from now, invalidate transactions trying to spend Bitcoin from older addresses that use cryptography vulnerable to quantum attacks. This creates a powerful economic incentive for everyone to proactively migrate their funds to new quantum-resistant address types well before quantum computers pose a practical threat.
Using economics to drive a security upgrade?
Smart. Yeah.
Anything else on the development front?
Yeah, there are also active debates and proposals around enhancing Bitcoin's native programmability. Things like OPCAT, which is BIP 347, and OPCTV, which is BIP 119.
Okay, what would those do in plain English?
Basically, they'd introduce new opcodes. Think of them as new programmable commands within Bitcoin transactions. These could enable more complex conditions for spending Bitcoin. The potential benefits include things like more secure bridges to Layer 2 solutions, more advanced self-custody setups, often called covenants or vaults, that add extra security rules, and potentially further improvements to the Lightning Network.
So making Bitcoin more versatile without compromising that core stability.
Exactly. It's this very deliberate, consensus-driven, long-term approach to evolution. It stands in pretty stark contrast to the move fast and break things culture you sometimes see in other blockchain projects. And it really reinforces that core value proposition of unwavering reliability.
Right. Okay, we've really covered a lot of ground today. We went from Bitcoin's current market standoff, that tug of war between holders, whales, and traders,
Yep.
to that surprising institutional rotation towards Ethereum, likely fueled by regulatory clarity on stablecoins.
Big shift there.
Then we looked at how corporate treasury strategies are evolving, moving beyond just digital gold towards investing in Bitcoin's actual on-chain economy, even with things like runes
The
tokens.
C2 blockchain example, yeah.
And we mapped out the global race for regulatory dominance, the US, EU, UK all carving out their paths. And finally, we touched on the quiet yet absolutely profound stability and deliberate foresight happening in Bitcoin's core development.
That bedrock stability.
So what does this all mean? Putting it all together, it really feels like we're in a crucial phase for digital assets. The purely speculative era seems to be giving way, maybe slowly, to a more sophisticated, more structured ecosystem.
I think that's right. It's becoming increasingly shaped by institutional flows, by strategic corporate adoption focused on utility, not just price, and by this global regulatory race that's actually fostering both clarity and competition.
Yeah, the market feels like it's transitioning, moving from one maybe dominated purely by retail sentiment swings to one increasingly defined by these more structured institutional forces, clearer regulatory guardrails, and maybe even the intrinsic growth of Bitcoin's own protocol-level economy.
Which leads to a really interesting thought to leave people with. As you see these global financial powers competing to regulate digital assets, essentially trying to bring them into the traditional fold. And at the very same time, you see the Bitcoin network itself meticulously building in technical safeguards against potentially existential future threats like quantum computing.
Right. Two very different kinds of future-proofing happening in parallel.
Exactly. So how might these seemingly disparate forces, top-down regulation and bottom-up protocol hardening, how might they converge? Could they interact in ways that redefine not just the future of finance as we know it, but perhaps the very nature of trust and value in our increasingly digital world? Something to think about.